months or so, we have been able to transact on a couple of properties. We disposed of an office building in Kidlington in Oxfordshire, which was a single-let office building, which we disposed of in August. And this we felt was a strong sale for us on the basis that we'd analysed our office portfolio and had identified this asset as one where we had concerns around its future performance potential, largely because there was perhaps some limited aspects of improvements that we could carry out to the building. We were able to capture relatively strong biomedical or life sciences market at the moment, and we're able to dispose of that asset above valuation, which is a strong result. And we also completed just after the quarter day in October, a sale of the lowest yielding asset in the fund, an industrial asset in Rainham in southeast London, which we disposed of, as I say, in early October. Again, another single let asset which Jason acquired in 2007. Very good acquisition in sort of £7.5 million, which we disposed of in October for just over £21.5 million. So very, very strong performance. But again, our rationale for that, whilst we still remain very positive about the industrial sector, was really around that low yielding nature of the asset, where we effectively had captured a huge amount of capital growth in that property, and felt that there was probably less to come going forward, in which case relying on a low income yield is not perhaps going to be particularly performance accretive to the trust. So we were happy to dispose of that.
The company had a strong first half with continued NAV growth, and that was demonstrating outperformance compared to the overall real estate market in the UK. However, we have already made an announcement about the valuation movement for the third quarter. That's from the end of June to the end of September, where valuations declined by just over 4%, reflecting the wider market movements we're seeing as a result of higher interest rates. So over the first half of the year, we concentrated on a couple of sales, increasing our liquidity within the company. And the reason we did that was we have a debt maturity in March 2023. We currently have a facility from the Royal Bank of Scotland, and I'm very pleased to say that we've extended that on a 3-year term, starting from April next year. The extension obviously reflects current market conditions though, and we've reduced the fixed term loan down to £85 million. It was previously 110. And we've extended the revolving credit facility, which is a flexible form of loan where we can draw down and repay as often as we like. And we've increased that from 55 to £80 million, so that we'll have some future firepower. So we've got just under 50 assets in the portfolio, and we'd be very happy to tell you about every one of those. And the reason for that is each one has a story. We've invested in it for a particular reason. And one of the key criteria we look at in assessing the suitability of an investment is how does it appeal to the occupier? If the current tenant were to leave, would it appeal to someone else? And we believe, as Mark mentioned earlier, about affordability being very important as one of the characteristics. So I'm going to choose an asset which is perhaps not one would expect. It's a relatively small 2-unit retail warehouse park in Leyland, just on the outskirts of Preston. It's adjacent to a Morrison's superstore, food store. And the reason I really like it is when we bought it about 8 years ago, it was let to Homebase and Argos. Homebase assigned their lease as part of a package to The Range. The Range is a superb budget type of all goods vendor and trades exceptionally well. And then the Argos unit, now I'm sure most people are used to the fact that Argos used to be on every corner of every high street, it seemed, but they've been retrenching. And mainly now they're occupied much more within Sainsbury's supermarkets. So at the end of their lease, Argos decided to leave. But very quickly, we had 2 or 3 potential tenants interested, including actually a gym, and we did a letting to the gym group. They're a very good tenant. They take longer leases than many retailers. The reason I wanted to bring this one to life, though, was I mean, it really, for me, was reassuring when we do see in practice what we say we like to see. And that is a unit becomes vacant for whatever reason, but there's several tenants who are willing to pay a similar rent to the previous rent. Or in the example, Mark's going to give you a higher rent, which is even nicer. So that we know that we do have a good quality asset, which is going to provide us with a sustainable income into the future. Mark, you've got a more exciting one, probably.
Well, I'm not sure about that, but it's perhaps the one that you may be more you'd expect us maybe to discuss more. It's an industrial asset, not a million miles away from the one that Jason spoke about in Bolton, and it's an industrial unit where the existing tenant vacated in the early part of this year. They were expanding and needed a larger premises, so they moved to larger premises, and we effectively got the unit back. And talking about this sort of demand from other occupiers, we had several parties came to us wanting to take that unit almost immediately after the lease end of the of the previous tenant, and we were keen, obviously keen to ensure that was possible. But what we wanted to do was make sure we took the opportunity to get into the unit and carry out a refurbishment of the building, primarily to ensure we maximise the potential rent that we could achieve from that new tenant, but also because, and this stems from across the portfolios, we believe fundamentally that ensuring you have good ESG, or environmental, social and governance criteria in our buildings will be a means of maintaining, if not enhancing, performance and value going forward. So wherever we get opportunities, we look to try and improve the environmental credentials of our buildings, as we do strongly believe that is a way of maintaining value going forward. So conscious that with this demand for this unit, that we potentially could be the last opportunity we have to have control of the building for, say, 10 or 15 years, we carried out, we effectively took the unit back and said, we will let it to you, but we want to take a period of time to refurbish the building. And we carried out a full refurbishment of the premises and enhanced the environmental credentials with an enlarged solar panel array on the roof. We've put in some staff well-being facilities in there, showers, etc., and also incorporated some biodiversity in the surrounding sort of soft landscaping around the unit. All of these things effectively are, what we're doing is future-proofing the building from an environmental perspective going forward, which we think is very, very important, and we look to try and do that across the portfolio. The added upshot, and again it comes back to why we remain comfortable with effectively our position with being sort of heavily invested in the industrial sector, is that the rent that we were able to achieve was about 17% above the previous passing rent, showing that the supply and demand dynamics are still strong for industrial property, and that we are still able to capture rental growth from good quality assets in good locations, such as this.
We're obviously in a really interesting time at the moment, with rapidly increasing interest rates, cost of living crisis, etc. Actually, that means that we're going to carry on doing what we've been doing for a little while now, focusing on fundamentals, ensuring we've got assets which will appeal to occupiers, where we're likely to see the strongest rental performance coming forward. We do expect some capital value falls, so we've taken profit on a couple of things, and we'll continue to do so where there's an opportunity. But the most important thing for us is to understand the thematics which will drive longer term occupational requirements and therefore rental growth. We will stay fairly heavily exposed to industrial and logistics assets. Those are likely to see continued rental growth due to ongoing demand with onshore or nearshoring of supply chains and a lack of new supply coming forward. We'd like to do a little bit more in the living space, apart hotels, maybe some operational hotels, student housing. I think that's going to also provide some continued strong performance. We're unlikely for the short term to increase exposure to offices, although at some stage there will be opportunities there. And retail will remain very focused on a limited area, which is the retail warehousing and affordable. Although we've got some sectors we really like, I think it's fair to say that for the next 6 months we're more likely to be conservative capital waiting for the best opportunities rather than increasing leverage. There is one other opportunity which we have, which I guess in many ways we prefer not to, and that's to buy back shares. Over the first half of the year, the company did buy back a significant number of shares at an attractive discount. We do this as an investment decision rather than anything else, and when we're trading on a big discount, it can be a very attractive proposition compared to going out and buying another asset. We say we like our portfolio. I guess that's the best demonstration where we can buy our portfolio at a discount. We really like to.